Verizon reported earnings before the market opened on Tuesday, and frankly, the results were a bit of a mixed bag. The market didn't really like what it saw. Shares were down a couple of percentage points today. But I want to go through the results where there's a little bit of good news, where there's maybe not so good news, and what the vision is for the future of Verizon. I think this is something I've been talking about for quite a while here, but the vision in the future is not only that you're going to get your smartphone connection through Verizon, it's that you're going to get your smartphone, your broadband, and then ultimately also streaming services. So all these things are going to be bundled together. And the value in being the bundler there is you're going to be able to take a little bit of a cut of each of these. Of course, broadband and smartphone connections are going to be what Verizon is going to actually serve themselves. But with something like streaming, Verizon is going to be able to take a little bit of a cut. So the margin overall is going to increase. And you're going to be able to spread your fixed costs over more connections, whether that's fixed wireless, whether that's more smartphones, whether that's smart devices, all kinds of different ways that Verizon can make money. So there is some metrics that we want to look at, not just the top line, not just the bottom line, but actually what those wireless numbers are. So we'll get into a little bit of that nuance and what we're seeing on the balance sheet. My name is Travis Hoium. Thanks for watching Asymmetric Investing. Please subscribe here on YouTube for all my content, and thanks to this video sponsor, The Motley Fool. If you go to fool.com/ASYM, they'll give you their top 10 stocks to buy right now. So let's go to the results. I'm going to start with some of the key operating metrics for Verizon. You can see that this is what has been pretty volatile for Verizon, is the number of retail postpaid net adds. This is basically how many net customers are you adding. Should be increasing that theoretically or hopefully over time. Verizon has not done a good job of that on the consumer side. In the fourth quarter of 2023, they actually had some really big hardware subsidies that drove a lot of that addition in customers, but that is not something that they're going to continue. I'll get to some of those hardware numbers because that's something you really need to keep an eye on as an investor. Business, they have done much better building these business relationships, adding the number of postpaid phone net adds. Broadband, this is the thing that I've been talking about for quite a while here on this channel, is what we really want to watch is the number of fixed wireless subscribers. I have been using this for a couple of years now, faster than cable is for me, and this is just tapping into the 5G networks that's in my neighborhood. So they doubled the number of customers that they think they're going to be able to have on this network because they met this growth goal about 15 months ahead of time. So that's really good news, is that broadband is increasing. What that should in theory do is reduce the amount of churn. If you have both your smartphone subscription and your broadband through the same subscriber through Verizon, you're less likely to cancel that subscription. That's basically the theory behind it. The revenue numbers are always a little bit confusing for Verizon because you're going to look at this top line revenue number that's flat. You go, that's just not all that good for a company that should be growing. But this is actually good news. $5.8 billion in wireless equipment sales a year ago. That declined by $500 million to $5.3 billion. What Verizon typically does is they subsidize the hardware sales. So when you go buy a phone at Verizon, they're going to actually include a subsidy with that because they want you to sign a long-term contract. They want you to pay the high margin revenue, which is services and other wireless services specifically. So you actually want to see this piece growing in red, not the other piece, the wireless equipment sales. This could go to zero as far as I'm concerned. That would actually help the company's margins. So services and other revenue up, total wireless revenue. So that's breaking this down even further. That was actually where all of the growth was, $500 million or 2.7% in this segment. So this is, out of all these three segments, hardware sales, service and other, excluding wireless and wireless, you want to see the wireless number growing, and that's what is growing right now. Cash flow, not all that good when you look at it from a year ago, but I do want to highlight something that they talked about in the conference call, and that's the one-time costs associated with severances and then also acquisitions. That was about $2.3 billion, $1.7 billion of that was associated with severances. So does that help lower their operating costs long-term? That's the goal. That's the theory. Now, this is what we need to see from Verizon, is that those operating costs are starting to come down. What we do see with this table is that capital expenditures are coming down. So free cash flow is relatively flat, despite the fact that you have about that $2.3 billion headwind from lower cash from operations because of those one-time costs. So if those didn't exist, you would actually have about flat cash flow from operations from a year ago, and total free cash flow would actually be up. The other thing that, and I'm going to dig into this a little bit more, but I don't like to see Verizon's debt increasing. This is something that has been long a risk for Verizon is that they're spending a ton of money up front on buying spectrum, on building out these networks, but then they never actually pay down the debt. You just seem to keep adding debt long term. I would much rather see them pay down that debt and give up on a little bit of this dividend growth, but that's clearly not what they're doing. And actually what they're doing is they're kind of doubling down on their growth strategy by acquiring Frontier, and that is actually hurting the cash or debt situation. This is a bit of a breakdown of their results in this segment. This is another file that they give with their earnings, but this is the thing that I'm going to be watching right here is their total operating expenses. If they are doing layoffs and theoretically lowering their operating expenses, if they're selling less hardware, you maybe don't need as many stores, they should be able to lower some of these operating costs long term. These numbers have been relatively flat depending on the quarter. You can see that it kind of jumps during the holiday season. But if that can step down a significant amount over the next few years, that should help the operating margin, which is hovering right around 30%. So keep an eye on that in the future. And again, this is the services breakdown. You want to see growth in this services line, not in wireless equipment. That was what happened in the fourth quarter. That was how they attracted all those new customers in the fourth quarter on the consumer side, but not necessarily good for your bottom line because there's a lot of costs that are associated with that. Here they break down all their connections, and what you see with total wireless from retail, this is about flat. But this is what I was talking about earlier is the total broadband connections growing pretty nicely, up about 1.5 million since the beginning of 2023. That is primarily due to that fixed wireless. So getting much more into the broadband business. Management said during the call that they would have the ability to serve about 100 million customers in a few years. So that's going to be both fixed wireless and the fiber networks that they're acquiring or building themselves. Churn, you're clearly going to see higher churn in the prepaid business. That's something that we see consistently. Wireless postpaid, relatively low at about 1%. So overall, churn rate coming down just a little bit to 1.61%. Every little point of lower churn is actually going to help your bottom line because it's pretty expensive to acquire customers. You have to do things like subsidize their hardware purchases. So this is where you do want to see that churn rate come down slowly over time. And then ARPA or ARPU, this is something that has been relatively flat for years for the wireless business. You would like to see this moving higher, but clearly it is not. Average revenue per account is increasing, but again, this is because you're adding more services like broadband to the accounts. I wanted to highlight this debt number because the total debt is about flat from the first quarter of 2023 because debt is kind of fluctuating right around that $150 billion number, but net unsecured debt is in decline. So $128 billion at the end of 2022, $121 billion now. That's why you see the unsecured debt to consolidated net income, that multiple. So that's why you see net unsecured debt to consolidated adjusted EBITDA or earnings before interest, taxes, depreciation, and amortization. That is coming down slowly over time, not real quickly, but it is coming down slowly. Also, total number of employees coming down slowly. So we're not seeing those cost savings quite yet, but in theory, that should be something that we're starting to see more and more in the future. So you can see there's a little bit of good news, a little bit of bad news for Verizon when you look at all the numbers. Thanks to our friends at The Motley Fool for sponsoring this video. Visit fool.com/ASYM for the top 10 stocks to buy right now. So a little bit of good, a little bit of bad with Verizon's earnings report. Dividend yield is still kind of the biggest thing to buy, 6.5%. But like I said, I would like to actually see them use some of that money instead of paying a dividend, actually pay down the debt, reduce the leverage and the risk that's in the business, because it doesn't seem like that free cash flow number is going to increase all that much anytime soon. Now, I think some of the strategic moves they're doing are moving in the right direction, but it doesn't mean that this is going to suddenly be a double-digit growth company or anything like that. So steady as it goes as far as Verizon's business goes and its stock goes. As I'm recording, PE ratio about 15, depending on where earnings are in any given quarter. It should be a little bit lower than that, but I think solid numbers, but nothing really to write home about Verizon. What you want to look at is in 5 years, are they able to actually bundle broadband and streaming services with more and more products? I tend to think that's going to be the case. That's why I'm still a shareholder. But until we see that happening, we see that improving the bottom line and free cash flow, it's okay to be a little bit cautious as an investor. Let me know what you think about the results in the comment section below. Don't forget to subscribe to Asymmetric Investing. Thanks for watching, everybody. See you here next time.